Okay, well now I've opened up our indicators here and we can look at the four components that make up this template. Now I do, as I mentioned in the first video, I have our toolbar and our initial balance and then just a price line on here. But with the individual indicators that make up the template are the volume zigzag histogram, the order flow zigzag, the buy-sell momentum, and the market extremes. Now market extremes is somewhat independent of what we're looking at here with regards to the zigzag and the momentum. We're including it as a bonus in this template here, but this is the kind of indicator that would be applicable whether you were working with this template or any template here where you're looking at extremes in the stock indexes. So I'm going to refer you to the individual video that talks in more detail about that particular video, but it's an add-on to this template to give you some additional value. So with that said, let's focus on what we've got here. So let's start with the zigzag. Now here, I mean, a zigzag, where was likely y'all are familiar with that, but what we're doing here that's somewhat differently is we're giving you some choices in terms of how you determine the way the swings are defined. So my preference is to use the ATR. So the thinking being I'm letting the market's volatility dictate the swing structure, but you could do it based on whatever your preference is. Could be a number of ticks, points, percentage, you know, and then see, of course, if you're using ticks or percentage, then you're going to define those here. I like the ATR. A 20 period is pretty standard, and that seems to work quite well. And then a 2 period multiplier for the ATR. So when that's how we would define the swings. But you might experiment with that a little bit. It's really about the function of how much detail you want to swing. So for example, if you look here at this downswing, well, if you change this, you might be able to get it to where, well, you would be able to get it to where you'd have a swing, a little retrace, and then continuation of that swing. So there is a little extra retracement in there. If you wanted to see that, well, then you could either lower the ATR period, lower the multiplier, or switch to points, percentage, you know, whatever your preference is. This is literally up to the individual trader how much detail they want to see in that swing structure. I think there's a balance there. Too much can cause over trading. Too little, and you're going to miss some of the important swing structure. So this is really up to the individual trader what your preferences are. This is just what I happen to like. Now, what's important to note here is that whatever you have reflected here in this zigzag, the zigzag that's on the chart, has to be matched exactly to the histogram underneath. So these three have to match between histogram and zigzag. Now maybe that's obvious, but so you couldn't have a ATR 40 here on one and 20 on the other, or points on one or ticks on one and then something else on the other. They have to be mirror image of each other, right? Assuming that would make sense to you. Now let me just keep moving through the parameters here. So additionally, we have the option you can show higher highs, higher lows if you want to. It can be helpful, you know. Sometimes it's a reminder, hey, am I going counter trend or not? Or if they're very close, did I get a higher high or not? Just personal preference there. Now, fib retracements here, this is kind of a little add-on feature that we included here for you. So what it's going to do is that on every swing and retracement, it's going to show you on the chart where the 50 and the 618 is. Now here we don't actually see any here because all of these swings have been broken. So for example, here on this upswing as we come down, well, we don't make it to a 50, so it's not there. Oh, if we were looking back here on the downswing as it came up, well, it looks like that's about a 50 there. So likely that would have been there here. But once it breaks the 618, the software will take it off the chart. So you wouldn't have it here. And then kind of the same thing here. This wouldn't be far enough. This on the way up, there would have been a 50 and a 618 waiting there to show them to you. As we break it, it's removed from the chart. Same thing on the way down. Now, truth be told, right, of course, I have the benefit, right, of having all the. But so if I had the resources and the capacity, I would much prefer to have the auto fibs, which is a different indicator, but it's essentially doing the same thing. The reason for that is because the algorithm that's tracking will absolutely be there on a swing-to-swing basis, but it will also use alternating swings, and you're going to miss all of that if you're only using this 50 and the 6. Of course, you could draw them yourself, right? I mean, so let's be clear that you could do that, but that's a lot to keep up with, particularly if you're trading multiple markets. That's why the auto fibs is so handy, because it'll do it on every individual swing, from swing to swing, as well as alternating swings. It'll do it on virtually every pivot that's on the board, so you get Those of you familiar with it will know that you'll get all of them on the right side, or you put them on the chart if you'd like. But my point is here, we did this as just kind of an extra value add here for those of you that may not have the auto fibs. If you're not familiar with that, that would be a video I would encourage you to watch. Oh, coming down here, the rest of this is just color choices. This is what you'll get as the default. But the core of this is the zigzag type that you're choosing, and then making sure that the two are matched. So if I go down to the histogram here, well, this is where, again, this has to be matched. Whether you want to show the divergence or the no interest longs, I can't think of a reason why you wouldn't. But so here, do you want to see the orange here, the line, and the orange highlight on that bar, and do you want the no interest signals here? I mean, again, you don't have to have them there. You could see it. You could determine it that way, but it's kind of convenient to have it on the chart. So there it is. Now it gets a little more nuanced once we get to buy-sell momentum. So let's start up here on the buy-sell momentum, and this is where you're seeing the arrows. So what we have here, now we have a lot of choices here in terms of bar type. That's actually what this is telling you here. These would be all the bar types that would be native to Ninja. In this particular case, because I'm using a non-time based chart and bar type, I've got to tell it the amount of time that I wanted to use to establish the delta that I'm pursuing here. So as it reads right now, I would be seeing, of course this is happening behind the scenes, just in the software. This would be 15 1-minute bars. And I'm tracking the average of the delta over those 15 1-minute bars. I want the software to notify me when I get above or below 2 standard deviations from that average. Now, this note here on the chart that you only see 2s and 3s, and that's very deliberate because I only want it to fire a signal when I get to 2 standard deviations from that 15-period average. Now, of course, this is all, you could change this to whatever you like. I mean, this could be, you could change this to 15 seconds if you wanted to, or I mean, really this is up to the individual, and then kind of fine-tuning it based on what your preferences are. On a 40 range chart here, 1 minute seems like a good fit here. Anything beyond that is not going to be relevant to, which is kind of the decision point that you're at. Is there aggression of buyers or sellers being reflected in that bar? So that's important to me. Now, if I change this to 1, then I would have bars that would have 1 arrow in it. Right here, because I'm at 2, you're only going to see 2s and 3s. Again, personal preference here. I find that if I do 1 standard deviation, I've got too much, it's a little bit too much noise. It doesn't take much, particularly if the market's gone into a kind of a consolidation period. It doesn't take much to fire an arrow on 1 standard deviation. So I think it can make the chart a little bit cluttered in terms of getting too much. I'm getting more than I need, and then that little bit of paralysis of analysis can kick in. 2 and 3 standard deviations, that's very meaningful, at least in terms of my interpretation of it. So I absolutely want to be noted when I'm that far from that, in this case, a 15-period average. But again, I would encourage you to do a little experimenting and find out what you like best here. So that's open to your experimentation. I think this is how it will. I'm pretty sure it defaults to this when we send it to you. But again, change it to your heart's content. These are just color choices for whether you want the arrows. I just want them to stand out, so I'm not confused, so I don't look at a glance and misinterpret. So bright green or white is how I've done it. Now here, I'm going to just push it over here. Now on the excessive volume, it's a little bit different here. So we're giving you choices here as to how you want to see that reflected. Now it could be a candle fill, could be candle outline, or it could be an arrow, which would be on the side of the chart. So having experimented with all of this, my recommendation here is to use either candle outline or candle fill. My preference is candle outline because I want to be able to see clearly with inside the candle. Now, just by that statement would imply that my suggestion to you would be to use the hollow candles, which are just native to Ninja. I would use those so you can see that. I tell you, it took me a minute to get used to it. But once you get used to it, I like that I can see this a little bit better. Obviously, I can see what's inside the bar, but I like to see if I'm also getting here. That's why I prefer the candle outline. So in this bar here, I can see that there's excessive buy volume coming into that bar, as well as the fact that I'm now 2 standard deviations from that 15-period average of the delta. Now here now this would be a mixed signal. I've got some sell volume coming in, but the delta is still above 2 standard deviations. And the reason I like the 2 and the 3 is that you'll find, not always, but often at pivots, you'll see us push to 3 standard deviations one way or the other. And then very often that's when you'll see the divergence kick in as the market can't sustain that. So just a more nuance, and then how it's reflected, that's just personal preference. And you might experiment with it and see which one you prefer. Having done all of that myself, I would encourage you to start here, and then if you don't like this, maybe tweak the others, or do a little experimenting yourself. Now let's talk about exactly what it's showing us. So I have it set to a 5-period average. So you can just think of it as a moving average of the volume. And what I'm trying to identify is when the volume is starting to cluster towards the top third or bottom third of the bars. So if I look at that 5-period volume average, I want to see if the volume is in the upper, in this case, if I'm seeing that volume's in the upper 70%, I want to be notified of that. Now I could change this to whatever I'd like, right? So it's entirely up to you as to how you set that in terms of what you want to see. But the thinking being is volume is accumulating at the upper thirds of the bars, and particularly with a range bar, because there has to be acceptance one tick beyond that to create the new bar. If I know that the bulk of the volume is at the top third of that, then that's just implying to me that more strength. And the same thing on weakness. If the volume is clustering at the lower third of these bars, I want it to tell me that, because it's more likely that sellers are plowing in and that sell volume coming down. You will see times like this where I have a mixed signal. I have the delta is above 2 standard deviations, but I have some sell volume coming in. And you see the next bar is a down bar, a wickless down bar. And interestingly here, as I stall, right, I've got new bars because I'm getting one tick beyond. Here I get a wick, but then here I've got buy volume again, but the delta has backed off. I don't get new delta signals till I get here, and then I get the reversal. I would encourage you to do a little experimenting here. This is just, this is just personal preference. How you color them however you like. Now, as I carry on down here, the show imbalances, these are a bit of a holdover or nuance that you would see in a footprint chart that we're trying to give you here, because of course the goal here is to give you something where you don't need a footprint chart. So show imbalances, yes, and the percentage to create an imbalance or define an imbalance. So if you're looking at a footprint chart, on our footprint chart, they will be color coded here. The way we're doing it in this here, this is a decent example here. We looked at this before. So I know within that, if I were looking at a footprint chart of a 40 tick range bar here, if I'm looking at that, I know I've got a series of 3 imbalances at this quantity, so at 400% greater than what would be on the sell side here. I've got buy imbalances. I got 3 of them stacked on top of each other. So it creates, and you can see it reflected here, a bit of a support zone here. So they take it up, come back and test it, right? It rejects it, comes back and tests it, and then up they go for the big push here. So these imbalances are part of the value that you get from staring at a footprint chart. Same thing with unfinished business. So as you see it down here, if I bring this over here. So this line being the dash dot right here, kind of a dash dot that you see here, this is an auction that's unfinished. So in a typical footprint chart, at the end or the top or the bottom of a bar, if it's a finished auction, there'll be a 0. If it's an unfinished auction, well, here likely sellers got left with business that wasn't complete. So you get unfinished business here, and again, that's a nice touch to know that that's there. Well, you can see it over here, right? So on this last little low, these 2 bars here may have been sellers that didn't get to transact, right? So we have unfinished business here in the auction process. The market tends to come back to those to finish that business. So just another nice little feature that we're adding in here. Again, remember the point here is to give you as much of the benefit and the nuance that you'll get from a footprint chart without having to stare at all of the individual bid-ask columns within, in this case, a 40 range bar, which can be very difficult to interpret. And of course, the other benefit here, I get that visual representation that I can't quite replicate, and I can't see as much when I'm looking at a footprint chart. So the imbalances, the unfinished business here, and the finished business, these are, again, pulling over some of the benefit of a footprint chart. And to some degree, it's the same thing here. I want to see that volume flow that I might see in a footprint chart. And I'm particularly interested when the delta gets extreme, when 2-3 standard deviations, so I know who the aggressors are. All right, so I think that covers most of the parameters that are available to you. It's relatively straightforward. It's the most detailed, most nuanced is here where you would have the most experimentation. The rest of it is just the zigzag is just a function of fine-tuning it till you get to the swing structure that you like to trade. Again, I'll save the market extremes for a separate video, and with that I'm going to wrap here on this bit, and then we'll perhaps you can look for some training videos of a complete template that would include more of our trade devils indicators in the way that I'll show you how I would trade it and how I do trade it. Okay, with that I'll wrap here and look for those training videos to come soon.